Hey good people, it's the Market Sniper. Yes, that's right, rat-a-tat-tat. Oh yes, we're in the T. We are talking about the Society of Technical Analysis. The Society of Technical Analysis, UK, wanted to troll the Market Sniper, yours truly, about what a crap TA merchant he is. In saying they did to a debt market, T-bond futures. We were on the 3-day chart. This was our tweet over here. 3-day treasuries. That's right. We were talking about the 3-day treasury chart. Looks to confirm our COVID-19 top of market call for the 40-year debt cycle. So this was one chart that was illustrating. If you had an eye, we didn't make it too self-explanatory, assuming that most people who follow me by now have seen more than just one tweet of mine, both on the bond markets, which we've been covering on and off for an extended period, would have noticed that there's a head and shoulder on there, and that in actual fact, that 3-day T-bond is actually triggering its neckline. And we go for the horizontal necklines. We don't do the traditional technical analysis with indicators, high focus on indicators, selling books, selling beginner courses about moving averages and all of the various things that you tend to find in these societies of academics and retailers. We go for HVF method, but nonetheless they decided to take me on and pick a bit of trolling with yours truly, and they said to me, using a 3-day chart to confirm a 40-year cycle, really? Well, there may be some validity in that. They chose to follow me and they chose to have a go at me. There would normally be some validity, you could say, to that if that was the only thing we had ever posted on the bond markets. In fact, we've been posting a lot. It's a head and shoulder. When you're talking to an audience and you're wanting to just show a pattern, you have to compress in a single tweet, in a single one image, a view of the potential reversal and of what's currently happening in the here and now. But in actual fact, if you take a look at our stream, we've in fact done quite a large amount of very long-term charts in terms of this. All of these shared publicly for free and in far greater detail in our premium community with the snipers utilizing HVF method, and we've highlighted, for example, this is the 10-year treasury note yield, the end of cycle in our view, crashing of the yields to all-time low, the final capitulation in our opinion as a technical analyst with a chartered market technician's qualification. Thank you very much. You know, the academic institutions love qualifications. I did the CMT through the Society of Technical Analysis, so they are calling garbage TA on one of their own members with a CMT qualification. They should think a little before they get into the game of trolling those that make their living by trading, not by selling memberships to societies. Anyway, the 40-year monthly chart, this was a major capitulation. This has been shared countless times on our Twitter feed. This was the 81 top where the yields were really, really high. This has been on a log scale. That's why this capitulation sensitivity looks so big. This is one of many such charts that we spoke. And in fact, we insist on being accredited with being very early on the end of debt cycle. No point before the COVID-19 event that occurred, at no point before did we call the end of the bond cycle. It has been a terrible trade for anyone over the last 30-40 years. Debt is popular to be blamed for everything, and it is and should be. However, calling the top on that debt has been an absolute widow maker of a trade for decades. 40 years is a very, very long time in most people's trading careers. It spanned my brother's entire bond management career. He was a qualified actuary, was a bond fund manager, and he was net long his entire career. And, you know, it still hasn't crashed, and he's retired and living the life of Riley. We did have a Twitter exchange with Rao round about this event when he was suggesting that this was going to be upside. I don't have his original tweet, but he was suggesting more upside for debt after the COVID-19 event that saw this bounce in rates. He was suggesting upside, and we said we think it's the beginning of the end. We think it's the beginning of the end, and in actual fact, this is grinding higher with deeply ascending. People have been trained so long to buy the dips. That's all they ever do on the bond market. It always pays. At one point, it will end. Much like the Fed put on equities that we think will also have a chance of ending at some point. Eventually, the dip doesn't get bought on the debt markets. And you'll see the date on this particular chart. All our screenshots, by the way, are dated through Snagit as and when they are taken. 2020, and that was July. The events were March, the end of July, the 30th, at around almost 12 in the evening, almost midnight. That chart was taken. That will take you back to couple of months into lockdown season, with everybody getting excited about buying the dip and further upside in bonds. So how did it transpire? Well, it didn't transpire, and it hasn't been transpiring so well for the debt market. And if the Society of Technical Analysts in London followed a little closer the people they want to shoot down, they would actually know that we've been covering this eventuality for a lot longer and in a far more detailed sense than any one image could ever curtail. This was the beginning of our suggestion of some convexity, which is man-peas off the roof, rolling over style, which was now a fail of this rising wedge, a break. It was slow and grinding at first, and it's exactly as I would expect it, because most people would still be on the bias of dip buying, as they had been so many times countlessly rewarded in this debt market of value. So remember something, guys. We are going to show you the actual T-note futures. Like you're seeing here, that's their actual value. And also we're going to be showing the yield, which is the upside down version of that same chart, and shows how little they were paying in rates as it continued to go down, down, down. So you're seeing a mix of both here. Don't get confused. Rates going down means value going up. Rates start going up means value start going down. Inverse relationship for those of you that are new to understanding the debt and bond markets. What else did we see in all of this? Well, let's show you all of these. This was our progression through this, and we were updating regularly. We were highlighting what we refer to as our grind line theory, which is well established in our course materials and program notes. You won't find anything like that at the Society of Technical Analysts. And why you skid and fall on what is now a rather slippery slope. Still, I will say to you that during the February months, this is now 2021, over a year ago, or maybe almost exactly a year, what's it, 16, it's about a year ago, no one was really seriously talking about interest rate hikes and inflation being a problem. Everyone had said, it's impossible to create inflation. Try as we can. QE. We can't create inflation. Everyone was bought into this. It was a mantra that was repeated. This came long before the eventual tales of transitory and not transitory that is in your more immediate mind of the events with regards to debt markets and rates. So here we go. We continue to forecast to the downside. We highlight also that the potential to come on down, which would bring it to this level over here, would start to make much bigger secular left shoulder, macro massive head, much bigger secular potential reversal on a 40-year bull market. The Society of Technical Analysts, we missed your call on this, and we still haven't seen it. It seems you haven't woken up to the fact that the bond market may indeed be turning in an entire trader's generation of life. You're still in the buy the dip camp potentially. Who knows what your view is? It doesn't seem like you show any awareness for the risk for debt markets. So this is now an example of the yield. So the boom in the highest point of the yields and the lowest of value for bonds was in the Volcker era. that was September 1981. It was coincided with a super spike in gold. Those of you will remember the early gold markets, and it followed as a result of Nixon's culling of the gold window. I'd drawn this particular trumpet when it was on regular scale, so now then when it went in log scale, it's a bit of a misfit now, but essentially it looked like that. We have broadening structures. How you trade broadening structures from trumpets, slides, etc. You will not find anything like that at the Society of Technical Analysts that have so much to say about other people that are active in technical analysis, supporting people to practically trade and to become millionaires in potentially in time. No rush, no sizzle, but build your wealth as we have done, as opposed to being society academics. So I have a fair amount of contempt for society academics who want to throw stones from afar and have not themselves shown any practical trading competence and don't seem to be aware of what's staring them in the face. Here's one of many accounts where during 21 we were highlighting the more secular reversal. By the way, also in all of this was an inverted HVF. They won't know about that. They're not trained accordingly. That structure over there down to there, why it had a target, why that target was made, and why you are now seriously looking down the barrel after what we refer to as a slap in the face event, a final melt up in the value of bonds during the extreme events. And if you don't understand the extremity of the events and the fear trade that was created by stopping the global economy from working, and you cannot potentially fundamentally even perceive that this was a door stopping event, almost the bookend to end a 40-year bull cycle where the entire macroeconomy was shut, and that led to that blow off high in the value, smash down, and then the subsequent buy the dip reflation that eventually fizzled all the way back down, as we had postulated, to that same 135 point, which was a falling wedge point to break to the upside, and does also confluence and give a potential left shoulder. So this is where we were at on the August of 2021. We were then saying we look for this to roll over to bring us down in the direction of the 135 to complete this particular scenario cast. I have not seen any scenario cast that were forward looking from the Society of Technical Analysts on the direction of the bond markets. I can't say I have ever seen anything insightful about the direction of the debt markets from my troll friends, but nevertheless, I'm sure they must be hiding those charts somewhere. Anyway, carrying on, this is then the 10-year Treasury, and this was the spiller in the rates. Again, we're talking about yield here now. So this was the end of the rates, the complete sell-off. And this was done on July, around about the same time. So you were looking at that previous chart at August. That was the valuation, where we're waiting for the right shoulder to come down. Now we're showing you on a smaller time frame on the 10-year that we're expecting, yes, this is pulling back, but you will go higher in time. Again, July. That was in and around 1.28, my good people. This line is showing you going up to, towards, and then through the 2% level. This is content that has gone through our premium community first, that has been scenario cast on the debt market, and for which some of these charts have been pushed through for free views on Twitter and on YouTube, calling the end of the debt bull market. That has been our scenario cast. That has been our views since very shortly after the March-April period, when we were challenging Raoul's view on it going further up in Real Vision in a Twitter dialogue that occurred in and around April, March of 2020. So to suggest by just showing a head and shoulders on a 3-day chart that we are have-a-go heroes that haven't done any detailed analysis on the bond markets would be a great mistake on behalf of any society in technical analysis that wants to point score on Twitter against somebody well recognized for doing his goddamn homework. Yes, sirree. Oh, I'm loving just putting the boot in. Don't worry, I'm enjoying it. These academies and societies, the smart aleck academia world, they were nowhere to be seen, the Society of Technical Analysts, in the inverted yield call that we gave on the 10-year versus the 3-month. That was leading to the repo rate problems of September 19, when liquidity in the interbanking market froze up, and we warned that a macro event leading to a big recession was coming down the pike. And what did we get? We got what is, in my view, a manufactured health event that gave an entire global economy shutdown. That is the end of debt market cycles that saw an obscene amount of money created through debt and pumped into the system that was absolutely already required as a result of interbank money lending breakdowns in repo, which incidentally, again, for my friends at the Society of Technical Analysts, we are on record on our YouTube channel 33 months before, suggesting that you will, within just under 3 years, face exactly that. That was in 19. Go back 3 months, 3 years almost, and that will take you to 16, the end of 2016. And when the travails of the end of 2016 were taking place, which involved the Shanghai Accord and a variety of other interesting China debt-related matters, we suggested that you will likely get your recession within 33 months, and it was bang on time with that LIBOR event. So our coverage on the debt market it has been reasonably regular, as can be witnessed. And we are worthy of so far being on the right side of what is a huge trade. We calling currently the end of a 40-year bull that every person who has tried to call the end of has largely failed. So it's a ballsy call, and it was made almost 2 years ago at the events of the lockdowns and March that followed. So it's kind of interesting, as I say, to have a society in technical analysis decide on themselves, because I would have normally thought they would have been slightly more demure and to themselves and more corporate. But nonetheless, yours truly has clearly upset them, and they decided to point out that we called a 40-year end of cycle on a 3-day chart, while quietly forgetting to notice everything we've done here on YouTube, here on Twitter. If you're not already following at the Market Sniper, you should be. You should be subscribed to the channel, and you will be getting the news before the news, well before these guys have even realized that there's probably a turn in the debt markets. By the way, in terms of reset thinking, it's absolutely required that the pull down in the debt market occurs. This isn't over. And today no less, these guys took me on the day before key, I don't know if they understand Forex Factory and understanding the key data events, but wait for it, we got a key CPI number out of the USA. That's right, 8:30 a.m. There you go, how we're looking, expected for the month to month, 0.4%. attained 0.6. That's about a miss of 50% to the upside on inflation, and core CPI also higher than that expected. Oh dear, the Society of Technical Analysts taking the man on 1 day before a key data point and absolutely getting it wrong, accusing him of being looking on short time frames and making macro calls and not knowing that there was even data to come out, or certainly doing a good job of not knowing. Let's see how it went on the data. Oops, remember that chart looking for that right shoulder? It just so turns out The bond market doesn't like inflation. Who'd have thought about it? Yeah, the Society of Technical Analysts are now looking at a full round trip right shoulder at 137, not very far away from our elected draw at 135 for a neckline, which is a pretty clean neckline in my view. Slightly chunkier right shoulder. Let's be frank, nobody wants the debt markets to fail in pension land. A whole bunch of pensions are going to become deeply, deeply worthless as debt starts to lose its value. Yields, we're in negative real yields in terms of real return. Most people understand that, and there is trouble ahead. By the way, where does this head and shoulder give a target for? We've gone for an aggressive neckline, 135. We might have pushed it up to 136 or even taken a 138, in which case you would have had key levels just run at a number of places. We've gone for the most aggressive draw, quite a tight neckline with just one or two key points. Oh, by the way, we're the ones that talk about armpitting and clarity about when the head starts and when it truly ends. And we only use horizontal necklines. The Society of Technical Analysts will tell you all about ascending necklines and descending necklines, and the gradient can probably get as steep as you like, as you want it. In the world of head and shoulders, it's a bit like when you have a hammer. If you have a hammer, everything suddenly becomes a nut. And this is part of the dead ends that these deeply academic first thing they teach you, reversal pattern. Let's be frank, most things, gentlemen and ladies, are continuation. Calling reversals is tough, and it will also take you to the poorhouse a lot quicker. So practical trading in these markets, being ahead of the game so that you have the true risk reward profile, not being seduced by academia in terms of these things, will serve you a great deal better. What does this mean for everybody? So many people don't understand debt or bond markets. Well, pensions are stuffed with them. People's ability to receive pensions will be greatly reduced if the value of those pensions continue to go down. If the interest being paid on those bonds are still well behind the official inflation number, and certainly well behind the unofficial inflation number. Bear in mind, shadow stats, 15-16% in America. You're running at about 7+% at the moment in official number, and you're paying not yet 2% on the bond market yield. These assets go down in value. They're paying insufficient income. The entire boomer generation may not get what they are just deserved. This points to a reset. This points to debt forgiveness. This points to the UBI. This points to many of our reset concepts that we handle on our Odyssey channel that you can go and find. The Market Sniper. Go search on Odyssey. The topics are not well cared for under YouTube, Facebook, and the fact-checking classes. Okay, let's have a little look before we sign off at the yields on that 10-year. We've got a couple of the debt markets that we regularly are updating our community with. Why? Because it goddamn matters in terms of where we are in the cycle and what potentially could be coming and when it will be coming, plus our take on those same FX markets that will also be affected by countries' inability to pay their debt. By the way, whilst we're passing by, the Society of Technical Analysts were not the ones that told you that in fact you would face a single-digit oil price for the first time in 35 years at the $60 mark, whilst that drone was attacking Aramco and you had the run-up here. They were not there telling you at 64 we're getting short. They were not there short Carnival. They were not there short Tullow. If they were, I'm sure they would have told us, given their struttiness on social media. However, they were not there to reverse that view. I've yet to see their bull calls as this falling wedge breaks. So be careful who actually puts real neck on block and gets things wrong regularly. Yes, sir, wrong regularly. And a couple of big things real right that nobody else sees on the macro charts, including the turning of the oil markets in both directions, down first and then up, and the debt markets. And these are the big moves that are absolutely key for us. So they put these lovely little icons on everything now. We got Tesla. I want the US 30, that is the Dow. It's actually the 10-year yield that we have an HVF set up on, and we've been highlighting, oops, traded through the 2%. Remember that 1.2% on the chart that we were showing you on this 10-year yield recovery? Yep, we were showing you that. Boom, chakalak, through 2%. Remember that forecast that had the green line through 22%? I feel like I need to get that same chart up again, but I think we closed them all. Which one was it? That's the one. Feeling lucky, punk? First time. There you go. That was the forecast after running 1.8 and actually having a pullback right down to the 1.2s. Your callers through the 2% on the yield, calling the reversal here as a head and shoulder of its own. 61.8% pullback, mild deflationary in the summer doldrums. That's right, summer of last year, aka June, July, August, September. You will go through 2%. Where was the Society of Technical Analysts forecast in that manner? They were trolling somebody on Twitter, I suspect. Oh dear, including ex-members and chartered market technicians. Oh dear. I hate pieces of paper. Look, I'm a CMT, I've got an MBA, none of that matters. What do you do in the markets? Technically, what have you called that no one else saw coming? Where are the big shouts that no one would have thought possible? I don't see them. I don't see them ever coming out of societies. Do you? No, sir. No, sir, I don't. Anyway, 2.022, that's a big move, and we're calling through a move through 2.2, roughly. And that is one continuation of ongoing continuation in our view. However, might it rest? Yes, of course. It may indeed rest. You are coming up to and have run a localized high that did exist. It is indeed possible that at some point you have a small pullback and you could complete a period of rest. And that could be on fear, it could be on a lot of potential aspects. But we expect the 2.2 to be run. Okay, so that's your update on the debt markets. And my friends, my dear friends, my stone-throwing trolls of academia, go and buy yourself a beginner TA course. They need the money, guys. It's tough. It's tough when you don't have it in you, to be, to make, to say anything relevant about the future. You just throw a couple of stones at people who are, that's who you get. You get the guys that do and take a risk, and you get the guys that point fingers at those that do, and that's your Society of Technical Analysts. Oh dear, bless him. Anyway, you can't all be winners, can you? It would be boring. Okay, I'm having too much fun. I'm going to love you and leave you. The debt markets got a real shock today. The inflation numbers still coming in hot. Let me just warn people I was in school during this is taking a sniper back into his tiny little pippy days, running around in his short pants and climbing trees. I can tell you, you don't kill inflation easily. It's something that's like a monster. You must kill it when it's little. It's already too big right now. The amount of rate increases required, we will have a full-blown correction in all asset classes to the downside if there is any serious attempt to redress the runaway inflation. 5s, 6s, and 7s that are actually 15s and 16s are going to continue to wreak poverty on the everyday citizen. absolute poverty on the everyday citizen. That is a hollowing out of the bourgeois and middle classes to the benefit of the asset holders, the billionaire class, and the poverty, the pure poverty, and the need for further welfare for the working poor. And it is absolute criminality, and it's a system failure driven event. They do not have the scope. They are too indebted to raise the rate sufficiently far. I would call BS on all those calling for 7, 8, and 9 interest rate hikes. If you get 2, if you get 3, for me it's a lot, and that's quarter points I'm talking about. If you've got a full 1 point up, I can almost ascertain to you that by then many of the assets will be substantially lower. And maybe this time the Fed put is pulled, just like the bond market turned for the first time ever. The Fed put on the equity market is pulled, and you get crash, all-time lows, negative wealth effect because of inflation. It could happen. Okay, thanks for watching, guys. Remember something: if you want to be part of real traders, not societies, community of people preparing for reset and building wealth in reset times that make ballsy calls with multiple time frame technical analysis, with a long history of following markets for a sustained period, and for keeping records and date and time, because we care enough about what we do that we are the Hansel and Gretel of technical analysis, which includes a spate of wrong views and then pressing home our winners, then you are in the right place. If you want beginner material dispensed to you by a society that gathers around for some cheese and wine, cocktails, la-di-da, and likes to lord it large and have a chin wag, but there is very few people that have made a 7-digit plus wealth out of trading the markets, then you belong with us. If you want the latter, you can go and have cheese and wine in London with all the other wannabes. Until next time, goodbye.